Everything in this video is not intended as financial or investment advice and is for educational purposes only. I am Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. I'm going to start with the usual correlation discussion to TradFi, SPX, NASDAQ. Bitcoin continues to attempt to break away, just unsuccessfully so far. We've seen a series of risk-off related headlines to Russia, Ukraine, certainly playing a role here in both directions. Bitcoin in the orange there. We're trying to peel away. There are attempts. You could argue that the correlation is decoupling slightly, but we're still rather coupled to legacy here, a lot of which is being pushed down by a move towards commodities just in general. So the question is if and when Bitcoin will act more like a commodity than a risk on equity, I guess you could call it, based on the correlations. You know, will it connect to the 10-year again? Potentially. Will it connect to some commodity index? Potentially again. Those are certainly things to watch for, but certainly recently we're not really seeing that just yet. You know, there was a valiant attempt here in March 1st, 2nd, somewhere around there, and we just got pulled right back down with everything else in legacy. Ruble continues to be the story. Russia, whether it's calls for regulations that already exist from lawmakers who don't understand KYC AML requirements, who don't understand that the chain is entirely monitored by chain analysis, law enforcement, treasury, FinCEN, everybody. You know, everybody's looking at this. It's not like it's a black box. It's not like it's the wild, wild west. Okay, those days are long since past. So in order to move massive amounts of money, any currency, you're going to immediately be known. Okay, I don't care if it's 100 counts from 10 different companies, right? It doesn't matter. People will know and find out about this. So this notion that we're evading sanctions broadly by ignoring the oligarchs onboarding is just absurd. Ordinary people using crypto in Russia is not evading sanctions. And the reason they would be using crypto is because their currency is currently worth less and less, seemingly by the day here. And if you're an ordinary person in Russia and you have the option to use crypto as a financial exit hatch, then you're going to do that, as would any rational person. So just as the ruble is being pummeled here, USDT ruble on Tether, or on Binance rather, continuing to see significant volumes on the Tether ruble pair. Now, I'm sure Binance is going through a lot of compliance discussions regarding who's trading at their institution, as is any international exchange right now. So again, this stuff isn't just happening on some other planet where no one's paying attention. Okay, everybody's paying attention. That's fairly obvious, hopefully fairly obvious. And it's probably obvious to the people who are calling for additional regulations. Look to the recent Bitfinex law enforcement seizure of crypto and how they traced and tracked every little sat that was moved. Okay, you can't evade the chain analysis anymore. Even if you use some mixer, even if you use Monero, arguably, depending on how you do it, you know, there's no easy way to just magically convert millions or billions of dollars and rubles or whatever into crypto. It just doesn't happen. Okay. And some of this is likely ARB, algo bots. I doubt all of this is actual people. But we can also look at, this is Nansen now. We can also look at Nansen's estimation of incoming and outgoing net exchange flow. And since the beginning of March, we've seen just this continual flow out of exchanges. What that means exactly, you know, I guess you could speculate on certain people moving money places. You know, I don't know. But if you look at this list from Nansen, it's impressive. It includes many exchanges I've never heard of. Paraboo, don't know what that is, right? BitMax. But this just gives you some idea, if you're unfamiliar, with the chain analysis capabilities right now, these days, right? In this day and age, okay? There are lists and lists and lists of exchanges like this, addresses, that are all being monitored continuously. So good luck. You know, if I'm law enforcement or if I'm a US government official, I want criminals to use crypto because it's so easy to see it, okay? We would see it immediately. There are bots on Twitter that automatically tweet large movements of coins or whatever, right? Okay, so This stuff does not go unnoticed. I just want to make that extremely clear. And if we look at the USDT and USDC non-zero balances, we're not seeing some crazy evasion stuff going on here with, some massive increase in balances, some shadow banking, whatever, right? Whatever accusations. It's just absurd. You just don't see it here, and you'd be able to see it here because it's all transparent. We did see a rise, continue to see a rise in USDT and USDC addresses with a non-zero balance. These individually don't necessarily represent people, but they do represent activity, let's say. And you're actually seeing a slight decline in that over the past couple days. Flipping gears to BTC, looking at on-chain activity, again, it kind of matches what we're seeing in price. Massive range, not really much action per se, bullish or bearish. And you're not seeing on-chain activity sort of lead price anywhere. You're not seeing changes in expectations of bias, for example. If I was seeing a massive decline in on-chain activity while price was flat, I'd say, okay, that's a bearish divergence, because you need some baseline of activity on any chain to maintain a price. So thus far, we are seeing some semblance of continuous activity per day in transactions. And if we look at active addresses, same thing. We did see a big spike in active addresses around the Russia invasion, certainly. And I'll take a look at that as well. But in the grand scheme of things, this isn't some, this isn't, millions of people all of a sudden trying to onboard secretly into Bitcoin or something. That just didn't happen. And you just see these large ranges of active addresses here. So we're not falling off the table. We're not screaming. We're not roofing to new highs. We're just maintaining sort of cruise control levels while price is flat. Now, if we zoom in and we look at the daily activity, this is activity in the last 24 hours per day. You can see there was a big spike in activity on March 1st or February 28th relative to everything since 2020. We saw activity like this comparable to that COVID down spike in March 2020. So there was, you could say, considerable activity on that day, right? What this means exactly, or who this represents exactly, would be hard for me to tell at first glance without deeply investigating, but I'm sure we'll see reports on that in short order from various chain analysis companies. And if we zoom out more and more and more, this was a decent spike in activity, certainly. Bitcoin's non-zero addresses, addresses with a non-zero balance, slowly rising, continuing to rise, a great sign of just continued activity maintenance. Again, you don't want to see this falling off the table like we did in 2018 for whatever reason, right? Maybe it was exchange consolidation, custodial partitioning, something, but we're not seeing that now. So that certainly is a good sign. If we look at the HODL waves, this is a realized cap, which takes into account the price at which the coins last moved, not just when the coins last moved. We're also seeing less and less activity since May. And by activity, I mean the people who are trading, the fly-by-night sort of individuals or entities, are dwindling, right? Just as you see this year after year. This was 2014, 2015. This was 2018, 2019. And this is currently. And the argument here is you're converting more and more people into hodlers. More and more people are holding their coins and not selling, not doing anything with the coins. Some people refer to this as an illiquid supply versus a liquid supply. One way to think about it. My argument is always, you don't move coins to an exchange unless you're going to sell. So if you're moving coins, you're probably going to sell most of the time, which is why we see, as price rise, more and more activity in hodl waves in the near term. So it's good to see this stuff quieting down. We're not seeing a bunch of capitulation. We're not seeing a bunch of people decide things look grim. We're not seeing any of that to that degree. Hash rate, something else to talk about. I had a conversation with a reporter at Bloomberg today, David Pan. We were talking about hash rate and electricity costs and energy. I think inefficient miners who aren't paying attention to energy costs will certainly be hit with mining profitability concerns, and we may see that play out in hash rate. The network's going to be unaffected, just as it was in China. We saw a 50% reduction in hash rate, and at the end of the day, it was basically a non-event other than rising block times for a little bit in that period. So it's not a concern for the network. If I'm a miner and my electricity costs are rising and I'm not locked in those costs as they typically do, then you may be hit with a bill you no longer are willing to pay, right? And then you just unplug the miner, you shut it off. That's one option. This could push more miners to seek out better alternatives for electricity, cheaper alternatives, usually greener alternatives for electricity, that sort of thing. So it's something to watch, not really a giant concern in my mind at the moment. Talk about ETH real quick. Transactions kind of flat. NFT volumes, if anything, have been declining. Fees have been declining. I'll take a look at that briefly in a second. But even still, I talk about this every video, but it's amazing to me that this baseline activity here is at the all-time highs of activity from 2018. So ETH is definitely a different animal than it was in 2018 based on network activity alone, and you see that on chain. 2018 was all about ICOs and ICOs not being able to deliver, ICO treasuries unloading. Now we're seeing just continued baseline DeFi, NFT, gaming, Web3, whatever you want to call it, bucket of stuff going on ETH just on a day-to-day basis. ETH's active addresses also just ranging here at previous all-time highs. Super healthy to see that continuously. Ultimately, if you're looking for fundamental value of a network, people always love to look at active addresses, right? Are people using this thing? That's the ultimate concern. And yes, they are. They're using it to the same degree that they used it at the sort of euphoric highs of 2018. And now this is just a baseline level. Addresses with the non-zero balance, again, rising. Just another way to look at growth, to show more and more activity over time. Currently, these are around 77 million with no sign of slowing here. So there's just continuous activity on ETH, sort of agnostic of price, regardless of price. One thing that is curving down slightly is ETH's hash rate. Unlike BTC, ETH's hash rate here has made some lower lows day over day. And any hash rate, any miner is going to get affected by electricity costs. So if, again, you're one of these miners who's sensitive to that or seeing rising costs, like my personal electricity is 11 cents per kilowatt hour, right? I'm not going to be profitable at certain levels of price plus fees. And as fees decline and price is flat, you're seeing a decline in profitability for miners, and you're likely going to see some of that hash rate come off. Price rising could make up the difference of the fee reduction, but all that's going to have an effect on mining profitability. All right, let's flip gears to technicals. I like the rainbow chart. It's simple. It's as old as Bitcoin, and not investment advice, certainly, but it does give you a sense of overbought, oversold. It does help center you, no pun intended, as far as where we're at in just the general grand scheme of things. And we're just cruising along at these levels. Not really that big of a deal as far as where we sit and the expectations of lows versus highs, right? Another way to look at this is pop on a pitchfork. If it fits, great. If it fits, meaning, do these levels get acknowledged by price in some way? Is it pareidolia? I don't know. I'm not going to argue that it isn't, but it does give me this warm blanket cozy feeling of, okay, we're in this range, this 2021 range, but we're also in this rate of change where eventually we're going to run out of road here by the end of the year, right? If we're at this price by the end of the year, we'll officially be out of this pitchfork. I'll take the odds that we start to curl up a little bit and sort of ride this upward. And so long as we maintain a price within this range, this rate of change expectation continuation is definitely on the table. So as messy and ugly and as gross as this price action has been, as volatile as we've been, in the grand scheme of things, zooming out, things look totally fine to me on a technical level. We're still below the 200-day moving average. We're still below the 50-day moving average. Something we definitely would need to recapture to start trending bullish again. There are times when we chop around and the MAs are meaningless. There are times when we have a nice move off of those MA crosses, right? I think most people like to assume it's called the death cross for a reason. It's called the golden cross for a reason. They like to assume price movements have a bias when you see these crosses, and they have predictive value, right? So it's definitely something to be watching for if you're bullish for Q2 like I am. And if you know the cloud, you know that this is just an ongoing trade setup, much like it was in May, June, July, where as long as we are in a range, not making lower lows, even though we did make lower lows here, we push probabilities towards a 50% retrace. In this case, the cloud points that out for you at 51K. So 51K is the level I like in Q2, so long as we don't make lower lows. We start making lower lows and it's a different story, but we are attempting to find the bottom here, as ugly again as this is, price-wise, as volatile as this is. And we've seen this before. Here's how it looked prior to the breaking up in July. This is called a long flat kumo. I'm just sharing this for people who aren't as familiar with the cloud, but it's the only thing I can see on this chart, right? I don't see lows. I don't see bearish strength. Another thing to note here is this TK cross. You can barely see it, this blue and red line. Much like an MA cross, it has significance for predictive value in regards to momentum. We'll say it like that. And just as you saw that in July, August, it's important to see that now. And it's also important that we don't crisscross to the downside if you're looking for a move to 51, as I am. And again, we see this long flat kumo over and over again. This was 2019 before this broke up. And you don't see these trades frequently. This was 2016. This was on the weekly. You don't see these frequently. But when I see them, it tells me, hey, we got a chance here. Now, in the face of all the fundamental stuff going on, you might think I'm crazy, right? There's no way we hit 51 in Q2. There's just no way, Josh. I'm not going to argue that, but as a technical trader, that's the direction I'm looking at, is 51. So I like 51 for Q2, right? We may continue to chop around for, another month? But between April, May, June, somewhere in there, I like 51 for BTC. Bitcoin dominance continues to curl up slowly, starting to get a golden cross here on dominance. This tells me you're seeing a move out of risk, out of altcoins into Bitcoin, and you may see continued strength here. This is another type of triple bottom consolidation and or inverted head and shoulders. But this to me looks like you're going to see Bitcoin strength much as you did N of 1 here, but 2019, okay, N of 2. 2018, 2019, momentum is certainly on your side for Bitcoin strength over altcoins. DeFi's in a little bit of trouble here as it's sort of at these June, July lows. It does have a falling wedge building, meaning a tighter and tighter range, pushing lows on less and less momentum. So it does have a bull div plus falling wedge. Again, it's another trade setup I like to take personally. I don't think it's ready yet, but it's something to continue to watch and monitor. Again, you have this flat Kumo level, you've got pivots, you've got the 200-day moving average, you've got the previous range, you've got volume out here at 10K. This is the DeFi perp, by the way. This is FTX. This is a market cap weighted index. A lot of this is Uniswap. A lot of this is just the top DeFi coins, but just gives you a general sense with a broad brush of what's going on in DeFi. So I do like this arguable magnet at this level if Bitcoin starts to look healthier again. And, if not, the issue is there's just this abyss of no activity essentially on this chart for price because there's no volume relatively in this zone, which is just seen as no support, right? We're kind of at the support that you'd really hope to see some activity kick in, some demand kick up here. Otherwise, you're essentially retracing the entirety of 2021, which some DeFi coins have done thanks to their own emissions, which like Comp, for example, has just retraced the entire thing back to the breakout in 2020. Looking at ETH real quick, again, it has the same vibes to me as Bitcoin as far as the technical analysis goes. Doesn't look as pretty or as clean for an ascending triangle, which is what Bitcoin is setting up for, but it does have that same 50% retrace to 3,500. The moment this breaks lows, though, on anything, all bets are off for that. Whereas DeFi, this chart, you'd expect this to just curl down and be okay. Charts like this, where you already have a series of higher lows, the moment you make a lower low, that's it, right? And then you look to the next support, which would be 18, and below that would be 13, right? Now there are highs at 18, there are lows at 18 that we haven't tested yet, so I'd assume we test those first if we go lower. But so long as we're consolidating here into Q2, into April, May, June, I do like 35 for ETH. ETH also has this crisscross setup on its 5,200 EMAs, so it's in a bit of a timeout from a bullish perspective, right? It is definitely telling you trend metrics are not on your side for longs here, and to watch for this crisscross in Q2 if you're bullish. ETH BTC looks just to me like a giant mess. I don't really have any analysis one or the other. It's this is the weekly. I think this thing just needs to relax a bit, especially if NFTs are cooling off, if DeFi is cooling off a little bit, general activity, euphoria, let's say, is cooling off on the ETH front. I don't expect ETH to outperform BTC in the near term, especially with dominance looking the way it looks, depending on how you want to view risk of altcoins versus risk of BTC there. And something like Solana as well, a lot of these charts kind of are in no man's land, right? I don't have a ton of confidence that these lows hold, but certainly I would continue to watch for a falling wedge type setup here. And this also has this flat kumo here, right? Like, all these charts basically look the same right now. In a bear market, that tends to happen. Everything sort of trends together. There's certainly some charts that look better than others that I'm not going to show in this video, Luna, for example, but this does have the trappings, the hallmarks of a falling wedge bull div. So something to watch for. So that's all for this one. Like, dislike, comment, share, subscribe. What'd you like? What'd you miss? What'd I miss? Let me know in the comments below. Happy trading.